So one of the most common tax questions out there is choosing between the standard deduction and itemizing your deductions. This is a choice that all taxpayers have to make, but the IRS doesn't really do a great job at explaining to you what you're actually deciding between. So in this video, I'll be breaking down the difference between your standard deduction and itemizing your deductions in a way that is simple and easy to remember, so the next time you come across this same question, you'll know exactly what to do. So first off, what actually are itemized deductions? Well, itemized deductions are essentially a collection of write-offs that you can take against what is called your adjusted gross income to arrive at your taxable income. So if you're not familiar with those two terms, I'd recommend checking out my income taxes video up here, which will give you the full rundown on what both of those mean. But essentially it takes you to your taxable income, which is what is used to calculate your actual taxes that you're going to owe at the end of the year. And like I said, it's a collection of write-offs. So it's made up of a number of different write-offs that all get looped together in this bucket of itemized deduction. And there are three main itemized deductions that are going to apply to most people, and then there's a few others that I'll mention as well that don't quite apply as often. The first itemized deduction that almost everybody knows about is the deduction for charitable contributions. So charitable contributions falls inside the bucket of itemized deductions. Additionally, you've got state and local taxes. So if you live in a state or a city that charges you an income tax for living in that particular area, you are able to write those off inside of your itemized deductions up to $10,000 per year. So if you live in, say, California and pay $25,000 per year in state income taxes, you're limited to the first 10,000 of those can be written off as itemized deductions. But say you live in a lower income tax state where you're only paying $5,000 per year in state income taxes, then you can only write off those $5,000 that you actually paid. The third big itemized deduction is your mortgage interest deduction. And this essentially allows you to write off some of the interest that you're paying on your mortgage for your primary residence. Now, similar to the state and local income tax deduction, there is a cap on this of $750,000 worth of mortgage. So for example here, if you've got a mortgage on your home, a $1 million mortgage on your home, you're going to be able to write off 75% of that mortgage interest for the year as an itemized deduction, okay? Because you've got $750,000 worth of mortgage to work with. If you've got a $500,000 mortgage, then you can write off the entire mortgage interest paid for the year as an itemized deduction. But once you get over that $750,000 mark, then you only get to take the percentage that is associated with the first $750,000. Now, there's also a few other itemized deductions like your investment interest expense deduction and your medical expense deduction, but these usually aren't going to apply to most taxpayers unless you have a serious amount of margin investing going on or you have a very large medical expense year, because with the medical expense deduction, you actually don't get to take any kind of deduction until your medical expenses are over 7.5% of your income for the year. So if you're making $100,000, the first $7,500 of medical expenses not going to be deductible. Once you get over that, then you're getting into the deductible territory, but that's going to be a very, very high medical expense year. So hopefully that does not apply to you. So those are the itemized deductions, but now let's talk about the standard deduction. Essentially, the standard deduction is an alternative to itemized deductions that is just a flat rate that you can take with no calculations required. And most people, especially young people, do end up taking the standard deduction as opposed to the itemized deductions. This is primarily because the standard deduction is just so large. The decision between your standard deduction and your itemized deductions really just comes down to which one is larger. And with the standard deduction being as large as it is, typically for young people especially, it's going to be the larger one. Now, just how large is the standard deduction? Well, in this year of 2021, it is $12,550 if you are single or $31,100 if you are married. So that's a pretty sizable write-off that you have to work with, and your itemized deductions would have to outweigh that in order for you to take those. Now, there's also two ways to increase your standard deduction beyond that typical amount. These will apply to you if you are either 65 or older, or you are blind. So in either of those cases, you're going to get an extra $1,350 added to your standard deduction. If both of those apply to you, so you're 65 and over and you're blind, you're getting both of those, so an extra $2,700 added to your standard deduction. And like I said, for most people, this standard deduction is going to far outweigh the itemized deductions that they'd be able to take. So that being said, who should actually itemize their deductions on their taxes? Well, it should be pretty easy for you to get a feel for which of these is actually going to be higher, whether it's going to be a standard deduction or your itemized deductions. I mean, if you don't have a house and you don't live in a high tax state, odds are you're going to be taking the standard deduction because you're not going to have most of those itemized deductions applying to you. But if you are someone that gives a lot of money to charity, you live in a high tax state, and you own a home, then the itemized deductions might actually make more sense for you. Now, if it's going to be a close call, what you can actually do is use what's called Schedule A of your Form 1040, which I'll have linked up down in the description below, that will actually allow you to walk through the process step by step. This is an official IRS document that they use for just this process, so if you do want to kind of do the numbers yourself, you can find that down below. Now, the next thing you should do is check out this video over here where I dive deep into income taxes for self-employed people. This is kind of a mini course where I go through step by step everything you need to know, all of the calculations. It's all in one place, all broken down very, very simply. So if you want to dive deeper, check out that video and I'll see you over there.